Just had a question from Amelia, which was, since stop losses are dynamic, what percentage of your account should you risk on a trade? And sort of, do you allow for the fact that you're using a wider stop only as an emergency? It's a great question, Amelia. Well, essentially, let's take this euro US dollar pair as an example. We have a euro US dollar downward bias for the session. There's been very weak PMI data out this morning from France and Germany, and the Eurozone showed a big contraction in the PMI data, which led to expectations for a very low economic reading for the second quarter for the Eurozone. So we have our downward euro bias. We are also seeing some US dollar weakness, and the reason for that US dollar weakness, if we just take a look at the dollar index, is with this mixed risk on sentiment, but we're not convinced by a full risk on sentiment. So we maintained our downward euro US dollar bias. And the question is if we'd entered this trade, say we'd entered this trade here at 108.17, where would we have put our stop loss? Now, the logical place for the stop loss would have just been running above some of these highs here as an emergency stop loss, just above the 1.09. So that would be around 100 points. So that should equate to a roughly 1% of your account if you're trading without leverage. So the general rule of thumb that I use is not to risk more than 1% of my account per trade. So you don't want to be risking more than 1% of your account on any single trade. And you want to allow that full risk on that emergency stop loss. So you would want to have, okay, that 100 pips is around 1% or less than 1% of your account. So you don't, Amelia, what you might think, well, do I allow for the fact that actually I would be taking off the trade much earlier if sentiment changed against me, therefore I could risk more. The problem you have with that kind of thinking, Amelia, is that it impacts your trading psychology, and then each pip is worth more value than you're necessarily comfortable losing, and then that can make it much harder to stay away from messing around with the trade. So I hope that helps, Amelia, to answer that question of how to handle dynamic stop losses. And a dynamic stop loss, for anyone who's not aware, is that if this sentiment changed, then we would just pull the trade. So if risk really did turn fully on and we started to see a further dollar weakness, then that would invalidate the euro US dollar currency pair, because we'd have reason for euro weakness and US dollar weakness. In that case, rather than waiting for our stop to be hit, we would just close the trade out as price sort of started moving up. But it's not the price moving up that makes us close the trade out. It's the fact that the fundamental outlook has changed. That's what's dynamic about the stop loss, is we close the position as market conditions change and invalidate our outlook.